All right. Well, welcome everyone to this evening's event. Tonight, we're going to be exploring Texas new construction opportunities. I'm incredibly excited to be hosting this event. We just got some new inventory released where we are even able to host this event. We haven't been able to do this in quite a while. So we're thrilled to dive into these options this evening. Lots of exciting things to cover. Just some quick housekeeping item, just to be cognizant of time, we will not be answering questions live tonight on the webinar, but feel free to still type them in the chat box. Kian and I will get back to you in the next day or so to answer your questions, so don't let that hold you back from sending them in. So with that, let's dive in. Sorry, one second. All righty. I know a lot of you that are here tonight, great to see you, but for those of you that I haven't had the opportunity to connect with, my name is Rachel. I'm a realtor and advisor here on the team at Marshall Reddick. I grew up in Seattle and then moved down to sunny Southern California for college. Have my bachelor's degree from Vanguard University. And my journey with Marshall Reddick personally started 10 years ago when my husband and I bought our first investment property as clients. So fast forward a decade and 8 doors later, I'm here tonight, seeing firsthand what this company's done personally for my own family legacy, and I'm really passionate about what we can do for investors. Because of that, I made the jump from investor exclusively over to team partner as well a couple of years ago. I'm definitely a true believer in what Marshall Reddick can do for our clients, seeing it firsthand myself. So our services. Marshall Reddick really is a one-stop shop for all real estate investment needs. So we were founded as a real estate brokerage. We help our clients buy and sell residential real estate. Some of those clients are shopping for their primary residence, or many of them for a vacation home, while a lot of other clients come to us as a one-stop shop for investment property services. And that's how I began my journey with Marshall Reddick, was by purchasing, like I said, purchasing investment property. We are also a private money lender, so we help our clients by providing private money loans on a variety of different programs. And on the flip side of that coin, we also have individual investors who fund each and every one of those loans. So people funding both sides of those loan instruments. We also have the Marshall Reddick Fund, which is available for accredited investors. It's an incredible passive income option for those who are able to qualify for that. And last but not least, we are also a property manager. We have in-house property management services in all of our primary markets. So if you're investing in real estate long distance, which the majority of our investors are doing so, your property manager is going to make or break your success with your property. So I can absolutely speak to the incredible services that Marshall Reddick offers as a property manager. I am also a client. And as you can see, our team here, myself included, we really believe in the services we offer. A lot of us are involved in every single one of these facets as clients, so we really do practice what we preach. So our markets, we offer brokerage services in 16 major metropolitan markets. Of these markets, our primary markets are California, Central Texas, Southwest Florida, Tennessee, and Kentucky. So I have clients almost every day come to me, say, Rachel, why do we choose the markets that we're in? That's an excellent question and extremely important to the health and stability of any thriving real estate market. So over the course of the last 4 decades, we have sold property in over 200 US cities. So we've really learned what works and what doesn't, and cut down to the very, very best, most competitive markets for our investors. So these are the different facets we look at, these 7 things. First and foremost, job market. Is there a strong job market there for our tenants to have reliable work, not just too dependent on one industry? The vacancy rate, is it a geographic area that has a statistically low vacancy rate? We're looking for economic diversity. Like I was saying a moment ago, we don't want to be too dependent on one particular industry. So if that was to leave, we want to make sure there's other employers, and a lot of them that make up the job base. Housing affordability, is it an area that people can afford to rent and want to be in? Number 5 is probably my personal favorite. Is it landlord friendly? Based on world events that were unforeseen the last couple of years, we've really seen this make or break the states that have the most successful tenants in place. If the laws are written to be in favor of the landlord, that really works in, like I said, in your favor if things were to go as not anticipated. So you want to make sure that you have property in a market that has laws that will favor you as a landlord. Are there strong education options? You want to make sure that the property is located near good schools, lots of extended education options. That is important. And reliable property management. This is a huge, arguably the most important next to landlord-friendly laws. Reliable property management, it's going to make or break your ability to succeed with your property. I've worked with non-Marshall Reddick property managers in the past, and it has cost me tens of thousands of dollars in things that I don't think should have been expensive. So knowing you have a property manager that has your back, that's open, ethical, and honest, and that all facets of the real estate transaction work together is huge. That's going to be imperative to you as an investor. So before we dive in, it is my pleasure to introduce you to tonight's speaker, Kian Oros. Kian is he and I were actually supposed to be presenting together in person this evening, but he got caught in a crazy Texas thunderstorm on his drive out to Houston this afternoon. So we both love Texas, but we have some crazy weather sometimes. Kian has partnered with me over the past couple of years to help dozens and dozens of clients together. And when I have the opportunity, I love to head to the San Antonio office, work with my team there. This particular photo was taken of Kian and I at Worst Fest in New Braunfels last November. A lot of our clients have purchased property here. It's a really beautiful town. If you haven't been to Worst Fest, it's a must-go event. Kian is an incredibly accomplished agent. His clients love him. We have a lot of clients we work with together that have come back time and time again to purchase more and more and more property with Kian because he is incredibly positive outlook, a very strong work ethic. It's not uncommon to get an email from Kian at 2 in the morning or later. And he's just incredibly organized. He knows how to win for his clients. So with all that said, I'll turn it over to Kian.
Thank you so much, Rachel, and I appreciate everyone who made it on tonight. We're excited to share with you some options. Like Rachel said, we're moving into a period where the buyer has a little bit more strength in the market, so that's a positive thing. I know a lot of people have been anticipating that for a while, wanted it for a while, so we're going to talk about the market, where things are at, and some options in different markets that we're in over here in Texas. A little bit, just background on myself real quick is of course, I'm a licensed Texas realtor. I recently am now a Texas real estate broker. So I do have my broker's license. I am, broker associate for Texas. I started in 2017. So this is going to be year 5 for me. How I kind of got my start at Marshall Reddick was leasing property. So, we have a leasing division, sales division, property management division, private lending. Like Rachel said, we really encompass everything under the residential real estate umbrella. So I started in leasing property in Austin, New Braunfels, Seguin, San Antonio, everywhere we had it several years ago, and that kind of gave me the background to know what job core you can see with a lot of different tenants, what areas get the best increases, different types of family dynamics that you may see in different areas, school districts. Gave me a wealth of knowledge in knowing what kind of tenant you can expect and what the investment will do over time. So that's my background, and I did that for about 2 years before transitioning into sales here at Marshall Reddick and doing a lot of the investment sales for buyers, some of our in-house sellers, 1031 exchanges between our various markets. So that's where I'm settled today. I now, of course, I still strongly do a lot of Central Texas. Rachel has now moved down to Houston, like she said we were supposed to meet. This is an office that we're going to be opening over the next few years here to try to build a presence. Houston is a great market as well, and eventually we'd love to have a webinar over what the market is here versus in Central Texas. But Central Texas has been always our strongest market in Texas, and we'll go over that here in a bit. Also, just sales wise, I have a lot of experience in investment sales. That's all I do. So I've already done 72 investment sales for this year. That ranges anywhere from single family all the way up to fourplex. So we really want to stay within that residential range. That's where our expertise is and what we have a lot of knowledge over for our market. And then I'm a lifelong Texas resident. So I've lived in Dallas, I have family in Houston. I lived most of my life in New Braunfels. As if you do know me, that's one of my top spots. I love New Braunfels. I think it has great potential. It's a highest growth rate city year over year. But I was born in San Antonio, live there now. Also have a lot of connections in Austin. So I've been all around the map and have connections here. This is my home. Live here, we'll definitely probably die here. So I love Texas and you know, biggest fan of it. So this is our team. I was just talking with Rachel. What's funny is this was our team during the holiday time. So I think this was last December or November, but just since then our team has almost doubled. We've added about, I want to say eight to nine people since this picture was taken. So we're increasing rapidly. You know, even though markets have cooled around nationally, Texas has stayed very strong, and we've increased our portfolio sizes and across our markets. Like I said, Austin, Seguin, New Braunfels, San Antonio. We're constructing a new office in San Antonio, and we are also reconstructing an office in New Braunfels, as well as having our remote offices in Austin and Houston. So we're very excited about that. This is our review, so we always encourage you to go look us up. We really pride ourselves in the client experience, our sales records. You can see just within our team of agents here, we've all amassed about 223 sales the last 12 months. So again, we've stayed frequently busy with investment sales, and our market has been still on the up and up. And we, again, pride ourselves on really good reviews for our clients and their experience buying out of state, and the clients that we also have in state as well. So everything under one roof, like Rachel told you earlier: sales, leasing, property management. This is just so useful, especially when you're buying out of state. It's very stressful enough to really have to go through the process. We want to make it as seamless as possible for you. But it's even better to know that you work with one team. We all work under one roof. Common thing that we see so much nowadays is there is a lot of property managers in the business, but a lot of them are remote. So you sometimes can see maybe a good deal out there for a property manager, but they're centered out of Seattle or Washington, or you know, they have maybe contractors in our market, but their staff isn't actually here. So we live here. We work in the same offices. If you can't reach anybody, I can reach them. I'll see them in the flesh and I'll bug them for you. So that's the client experience is super important, especially with such a hefty purchase. This isn't a car. This isn't, you know, insurance. It's a home. So you really want to know that the people that are managing that for you, your wealth assets, the most important one, I think, honestly, you can reach, and they're real, and they're in the market that you know, you bought in. So again, we're a one-stop shop. So this is our property management fee. This is for Texas. You'll be able to see this on our website. This kind of breaks down the fee structure of what you can expect. And the cool part, we'll go into some stats later, is that we build these numbers into the price projections for investments. So if you go to our website to see in different investments, you'll see different line items for leasing, for vacancy, for management fee, all these things that occur over the life of the investment. And so this is just a general outlook of the fees that you'll get, but we'll build that into the analysis that we do for your properties, so you have a good feel view of how the investment will actually perform. So just we're not too heavy on the fees. It's 150 for a lease renewal. So kind of what that means is if your tenant renews for the next 10 years, that's a great thing. And we definitely see that. One good theme about what this seminar is about is new construction. And that really tends to be mostly A-class property. And with A-class property, we really see the tenants stay more often than not. As the classes go down for the property, as it's older, we usually see tenants not renew. So 150 is the only fee that you have to pay every year. And a lot of people may ask why there even is a fee, but management works really good with the owners usually about 1 to 2 months before the vacancy to really negotiate between you and the tenant, because we really want the tenant to stay. We don't want you to incur a vacancy, but we want to get you market value, if not better, for your property. So we're trying to negotiate that and work it out best for both parties, secure that deal. So it is a 150 fee, but you don't have the 50% leasing fee if we have to revet and market the property again, do background checks, credit checks, all of that. So that is definitely a plus. This is our map here. It doesn't include Austin, Houston. This is just our San Antonio metro. So you can see here we're all over. More times than not, if you already have a property that's not with us, we probably have a property that we're managing right nearby. These are a lot of the good areas that we manage in throughout San Antonio. We've been in the market so long, we really vet the areas out in the neighborhoods and make sure that we have kind of a basis of knowledge there, that we have a track record there, and that we've seen how those properties have performed before we, kind of push you in either direction based on what your goals are. So this is some Texas information, some overview. So a couple of stats about Texas. Texas is, of course, the second highest population in the country, next to California, which I know a lot of our clients are from. Texas, like Rachel mentioned, is super landlord friendly. Its lowest market default rate through COVID in our company. And I'm pretty sure, a lot of the stats reflect pretty accurately for Texas staying within that range, even across other property management companies. But we're in a lot of different states, and Texas fared the best when people were out of work. And so it's good to know that there's that stability there. We'll get into more of the reasons behind that in a bit. Central Texas in particular, let me see if I can briefly, we'll get to a map here. It's a minimal disaster zone. So the good thing, this is the Texas Triangle, if you can see right here. So it kind of connects Dallas to Austin, to New Braunfels, to San Antonio, and then we move over to Houston, and this kind of makes a triangle. So Houston and Galveston, of course, are along the Gulf. As Rachel told you, I got ambushed by a thunderstorm. Rain is a lot more common, flooding is a lot more common, hurricanes are a lot more common along the Gulf. And so up where, Rachel is in Houston, she's in North Houston by the Woodlands. She's more inland, so it's not too much of an issue, but a lot of Houston is closer to the Gulf. So that is something that they incur there. Dallas, of course, is part of it is in Tornado Alley. So Dallas does get tornadoes from time to time. Of course, West Texas has droughts. It's very dry over there. That's the terrain. And in Austin and San Antonio just have the muggy weather, but there's really nothing unique to Austin or San Antonio in terms of any of these things that we're talking about. So it's not disaster proof. I wouldn't even say any place is disaster proof, but that's one thing to keep in mind. A lot of our markets are near huge bodies of water, and so you always run the risk of having higher insurance deductibles, premiums, etc. And that's luckily something that we don't really have to deal with here. Central Texas has a pretty diversified workforce. So if we go back to the map, we have Austin, we have New Braunfels, we have San Antonio. San Antonio is known as the military city. So it has the most retired military, most active duty, most military bases of any city. And it has a lot of government workers. We'll also see here in a little bit, it has the biggest medical center. Austin, I'm sure as many of you know, especially if you're from the Bay Area, has grown a huge tech presence. So with that, a lot of companies have moved into Austin, and that's kind of been a slow burn. It's actually it was already happening before COVID, so that wasn't new, but COVID kind of propelled things for Austin, and a lot of companies like Google, Tesla really propelled that movement forward. And we'll see here a few other companies that are in transit towards Austin and Greater Austin and how that's driven things. But that just goes to show you between those two markets, the stability and the money that's moved into Texas over the last few years. And that's kind of funny just because Texas is pretty not it's I think it's about a 10 million difference between California's population and Texas's population. But New York and California, of course, are very expensive, different kind of demographics there. They're a little bit more tenant friendly, if you will. So Texas still having the great infrastructure, now having the job core that a lot of these areas used to have in other states like New York and California, it's really propelling prices upwards and doing great things for appreciation. So we've seen us still be able to maintain good cash flow, but with that job core moving in, people can afford more, and that really goes into the budget of what they can buy a home for, and that over time moves house prices up again over time. So here's a few stats, of course, on Austin Round Rock area and then San Antonio, New Braunfels. I'll have you guys take a look at that real quick. And then we'll just go to the map one more time. So these are the price averages for the different metropolitans that we have. So Austin is going to be our highest price index. This is the most expensive city. Coincidentally enough, this is actually the lowest population city over the 4 metropolitans. Dallas comes next. It's about 370 overall. Dallas, if you combine Dallas and Fort Worth, it is the largest metropolitan together. Houston alone is the biggest city, but again, Dallas and Fort Worth are technically one metropolitan, so they come pretty close. San Antonio and New Braunfels are still very affordable, so they're going to be the lowest average home price in the low 300s. This kind of takes into account your average single-family home. A-class. So of course, if you're looking for something that's a little bit older, you're willing to compromise in some areas, you know, you can definitely find something below that range in a lot of these markets, but these are going to be what a nice A-class, newer home, less maintenance is going to look like in these areas. These are a little bit of the population stats, just so you can see. So as I told you before, Dallas, Plano, Irving has about 4 million people. Fort Worth has about 2.4 together. They're at 7. Houston, not too far behind that. So those are really big areas. You guys may wonder why that even matters towards anything, but it just goes to show you that San Antonio and Austin have a lot of room for infrastructure. As more and more people pour into these cities, they start to go through infrastructure struggles the higher their population gets, and it's harder to grow at the same rate year after year. 2 million, 2.5 for San Antonio and 2.2 for Austin shows a big ability to still grow, and that there's really not that many people there quite yet. And Texas has a vast amount of land, especially Central Texas. That's kind of a different thing between at least Texas and California, is there is a lot of viable land in Texas. Building permits are pretty strict here, but in comparison to a lot of these other states, again, California, there is the ability to build in these areas and move those house prices even larger as those cities really continue to grow. These are the medical center stats. So a lot of people really think that Houston is actually the medical center leader of Texas, but it actually is San Antonio and their Methodist medical center. So just an interesting fact, kind of to go with the job core that we were talking about earlier. San Antonio, again, is the lowest cost price index in Texas. Again, like I was saying earlier, its population and job core really drives the stability of the market. So, you know, one thing about military and government work is they have pretty guaranteed income. So, you know, through these economic times of uncertainty where maybe certain industries like tech or manufacturing or commercial are, maybe in shift, government and medical are always a necessity. So that really keeps prices a little bit lower than those other markets like we discussed, but it keeps it in a steady influx up. So if you're really looking for long-term stability over time, good cash flow, good rent increases, a good safe bet, San Antonio is really that, and you're getting it at a really, I mean, I hate to say because it maybe sounds like a negative, but a discount. So across all the other Texas cities, again, it is the lowest price. So these are a few stats over the Texas San Antonio market. These were taken at the beginning of the year. So even since, these have gone up a bit as interest rates have climbed up, people have retired the idea of buying right now. They may wait another 2, 3, 4 years in hopes that rates will find their way back down, as they probably will, maybe not to where we quite saw them before, but eventually get back to some normalcy to where a lot of people can afford to really get what they want. And so that pushes a lot of people into being renters for the next few years. Great for those of you who already own property that we're managing, even greater for you that have plans to maybe do that this year. So in as rates are going up, this is going to be a trend that we'll probably see until we start to see some movement go back down, which will probably not be until later next year or the following year. So we're talking 2023, 24, or possibly 25 before we start to see the renting market cool. So we've started to already see the effects of the sales market cool, but that has had an opposite effect on the rental market. So it's still been very, very hot. So this is the stats of San Antonio. You can see a very good steady line over time. So this kind of shows you the stability of our market, even through a specific recession that was for real estate, not real estate only, but that was the major focal point of the 2008 crash. You see that prices stay pretty much break even. And we did have that negative year for a negative 2%. And that's really across the whole board for San Antonio Metro. So certain areas, even in 2009, especially the A-class areas, were closer to break even at that time. But other than that, you're really compounded at about 5% for all of these. This is really stats on the last 25 years or so. So we always want to be conservative with what we anticipate appreciation will be for holding 5, 10 years. As you can see in these more recent years, we're getting closer to consistent double digits. But we don't expect that will be forever, and we certainly don't want to promise you that it will. But when you're looking at these markets, you need to look at the stats and see how things have performed over time. You're really wanting stability for the value of the property, so that your money is growing in that way. And then also look at rental stats. We don't have these here, but you can see over time, like we looked in the last slide, how rents have gone up over time. So just the average at the beginning of the year was $1,850. We're really, for a lot of our A-class properties, at almost about $1,950 now, with a lot of Texas areas all being 2,000 and up. So that also is a big factor into how you really vet areas and their stability over time, what they're going to do for your money and passive income.
Definitely. Hey, can I hop in on that last graph or slide real quick? One thing I always like to tell our investors too is it's when you compare San Antonio Metro to how so much of the rest of the country performed during the previous correction, like Kim was saying, it was barely felt. If you look at some other markets like Nevada, like other areas took 40-50% corrections, like got hit incredibly hard. San Antonio barely felt it. Same with Austin. The numbers are pretty comparable. But the other thing I always like to point out is this, the last correction happened before this huge mass migration of companies and residents into Texas. So in the event there is another correction, historically speaking, these markets were insulated, and now more than ever, we have this huge influx of all these new permanent residents, moving into the state, myself included.
Like
Uh,
you.
yeah, totally. So, we've seen hundreds of companies relocating to these two major metro markets, literally billions of tax dollars coming in. So it's a really positive thing to see how well these markets responded in the last correction. So if there was another one, I think we're positioned arguably to do even better this time. So I just wanted to hop in with that.
Definitely, definitely. And this is our new Braunfels and Seguin packet. We have one on New Braunfels, Seguin. We have one in San Antonio, Austin. Don't think we quite have one for Houston yet, but I'm sure it's on the way. So look at that. That gives you some more. If you're a numbers person, I don't want to bore you guys all day, so we're going to go into some real life examples, but that will have all the information more in depth about Job Corps, local employers, specifics on appreciation, return on investment for these areas on a local level. So we'll talk really quickly about cash flow versus appreciation. We're grateful enough that in Central Texas we have quite a bit of variation between San Antonio and Austin and what those investments look like over time. So we have investors that purchase in Austin either cash or a high amount down, really with the intent to hold long term as Austin really continues to grow and expand, to see their money and the value go up the most. And as we've seen in the data, Austin has done that very successfully historically, even before COVID. Seguin is a safe hold. Like we showed with the recent stats, it was very unfazed by the market. It's been a steady increase. It's affordable and well within the range for what a lot of investors can afford, especially for a first or second purchase. And New Braunfels is kind of that soft medium. So this is I-35 stretch, and if you've worked with me before, I mention it a lot, I vouch for it a lot because it's the main connection between a lot of central metropolitans of our state. So it goes from the border to San Antonio, to New Braunfels, through Austin, all the way up to Dallas in Oklahoma. So it connects a lot together. A lot of commercial projects have been moving along the I-35 stretch, a lot of residential projects as well, mass developments, over 55 communities, affordable housing, luxury housing, all of the above. So, there's not a one size fits all for every area. We give you general numbers. So when you make a consultation, we talk about your goals. One of the first things I'd ask is kind of, what are you hoping to achieve with the investment? How long are you looking to hold? Is the passive income something you need at the immediate? Sometimes people are well within their careers. They see themselves holding on to that career for a long time. So the actual cash flow that they receive from that investment is not a necessity. They much more want to hedge against inflation. They want to wealth build. And it's great if you can try to find the medium. So in a lot of areas you can find some decent cash flow and you can find some decent appreciation, but most times they're not going to be mutually exclusive. Most areas, as they start to trend towards higher and higher appreciation, they delve away from cash flow. They become disconnected in what the rents do versus what the sales price do. So that's, if I ever say that an area maybe has become unbalanced for rents versus sales, that's kind of what that means. Austin has moved into a more unbalanced market, so you have to make compromises to get in. But over time, like I say, the values have tremendously grown over there to where if you bought 5 years ago, your money would have traveled much further than the San Antonio investment. But your cash flow margins would be significantly better in the San Antonio property. And in the New Braunfels property, you'd be at a more even balance between both. So interesting thing that, two markets that are so close together have such an interesting dynamic. I don't know of an exact replica of that may be elsewhere in the country, but I'm sure as both areas grow together, San Antonio probably will become unbalanced and will be harder for a first-time investor to get into. And there'll be another area in Texas that maybe is more rural right now, not as populous, that will start to move to be a better place for first-time investors, whereas San Antonio will move to be more like Austin and Austin will be way out of the picture. It'll be, who knows, like LA, completely out of the thought of for an investor to get into. But this kind of shows you some products. We've had multiple communities with the same builder. This is 210. This is a duplex builder, and it shows you where all those communities were priced at in 2019 in various areas and where those price points are now resale. So they were all kind of floating. This is 350s to, so you're in the mid 300s to high 300s for 2019, and where those have traveled to now, you can see the big price differences. So again, the one in Buda, more expensive at the time, tighter cash flow, but has almost doubled in value since, and a lot of people may say, well, I doubt Austin would be able to repeat those type of numbers time after time after time. But as I even showed you in the stats earlier, Austin is still the least populated city out of the 4 main metropolitans. So there's still a lot of room for growth there. But even if that wasn't your priority budget strategy, New Braunfels is a really good second hit. So it still did really well for the performance of the numbers in the New Braunfels duplex. I guarantee you that one did significantly better for cash flow. One thing that we see kind of be the detriment of Austin is that the rents really are almost the same as areas of New Braunfels because they have so much rental inventory. And so simple just dynamics of supply and demand, the rents can only extend so far. And so that's how, again, the dynamic works when a market becomes unbalanced. But New Braunfels has grown so quickly from a small town of 30,000 people when I used to live there to now 100,000, that the infrastructure hasn't been able to keep up quite. So we just don't have enough rentals there. We don't have enough houses for primary residents. So it's going to be quite a while before a smaller town like New Braunfels catches up. But Austin and San Antonio are bigger cities, therefore they have the infrastructure. They have older inventory, newer inventory. So there's more houses overall, where New Braunfels and Seguin are younger cities that quite don't have extensive history of having a lot of housing yet, but still just a massive amount of interest for people wanting to live there because they have enough close proximity between 2 big cities. And as I said with Austin, it's become tech-based, and so it's not too uncommon that we see tenants and even buyers that want to live in New Braunfels, San Marcos, or Buda and commute into work once or twice a week, and then the rest of the time they're just working from home. And that's because it is still expensive in Austin. It's very chaotic there. It is more traffic that comes with any city, especially one like Austin that has so many events going on all the time. But New Braunfels is a little less chaotic, more family friendly, better schools. So we see a big surge of people that maybe work either in the San Antonio metro and commute, or the Austin metro. I know this, both of my parents commute to Austin for work, still do. I have a lot of friends that do, and we have a lot of tenants that do. So it's not, may seem out of the norm. It's about a 45-minute stretch, but we see it pretty frequently than you'd expect. And this is just some cash flow numbers, so it shows you that maybe in a few of these projections that in year 1 it may have been a slight negative for a lot of these properties, but over time, again, a big factor, even if a property is slight negative, you want to see what the rent increases look like, so within the first 3 years that you're going to get to a good position on that property. So with this one, by year 3, they're already back into the positives. And for a lot of these, I think this is for the example on the New Braunfels one, they've made, by year 2, they've already made $60,000 on the value side, and they're in the positives in year 3. So you do have to start somewhere. I know it's never great. You want the perfect investment from year 1, but these are long-term holds. There's other investments, and Rachel's a great advisor, so she knows plethora of markets, plethora of things on the private lending side that may be more immediately gratifying. But again, if your thing is time, this may be the better strategy for you. So this is A class versus B, C, D class, and so as we're talking about new construction is more along the lines of A. And if you're kind of wondering what dictates the class, we have a book on that on our website that you can look through, and it will show you all the different dynamics of what drives what makes a class. It's really an overall grade of the property, and that comes down to the area, the rents, the job core, the maintenance on the home, and how old it is. So just because a property is new doesn't mean it's automatically A. You can have a great new property in a very high crime area, and maybe that doesn't pan out to be A. But more times than not, especially ones that we're putting out to you guys, it's going to have a good school district. It's going to be near a good job core, and that's the whole point. We want a pretty seamless experience, especially if this is your first home. It's a good area. We see good rents. That the house is very low maintenance. There's warranties in place, and you'll have a good experience for your first. And usually for those properties, we'll see the values go up more over time because your tenant's also having a good experience. So they're willing to stay there over time, saves you money because you don't have to see them vacate. And then one day, if you do want to sell it, usually the nice single family homes that are well kept, good areas, good schools, maybe amenities with pools nearby. That's the ideal property of what everybody wants. That's what you can call the American dream. So Rachel, I know can attest to that. She does have a fourplex that is newer. I know that, in several different investments, maybe that is that what you would probably attest to, Rachel, for the investments that you've had, newer
Yep,
versus older?
definitely 100%. What comes across looking like shiny with cash flow in lower class properties and ended up costing so much more down the line versus what you make year over year with your rent increases and appreciation with A class. I could not agree with that more.
Yeah, it always, I mean, the good insight that we have is that we start with you from here if you're buying, and then we travel all with you up until the point where you get your first rent check, and now we're managing the tenant and we're managing the repairs. So we really have the insight of how painful certain investments can be, and I can tell you it's usually 9 times out of 10 it's not worth it for these older properties. I see all sorts of videos nowadays with social media about getting just a horrible property and putting money into it and leasing it, and they have this great cash flow. And we'll get into some numbers here in a bit, but variable expenses, we call them variable expenses because they vary. And the lower the class, the harder it is to estimate what that variance will be. So the closer you get to A class, the more and more predictable that investment will be over 10, 15 years. It's new, it's up to modern day codes. So we've all known that over time codes have gotten and local ordinances have gotten more and more strict. I'm building a house right now in Shirts, and it is very difficult. But you have the reassurance that you're doing everything up to code and what modern construction is. But if you buy a house 10, 20, 30 years ago, maybe they didn't build foundations to what we build them today. So you're incurring whatever older information we had for construction at that time, and the negligence of possibly the owners it's seen since then. So, that we've sold older investments. I just think, especially if you're first time, that may be not the best choice. And we really do a lot of vetting through the escrow process to make sure you fully understand the cost associated, the numbers of everything, so that you really have a broad scope of some of these older properties. But again, for numbers' sake, it usually hasn't made sense in more recent history. We could come to a time and again where maybe older properties do make sense, and we have enough of a labor force, and we have good materials, and we have enough contractors to where make ready and flips are pretty seamless. But hasn't been the case. Hasn't been the case since COVID, so that's not what we've seen more recently.
And also just like with San Antonio Metro in general, there's the opportunity to buy new builds in established neighborhoods. Like my most recent acquisition was here, like Kean was saying, I'm near the Woodlands, and I bought an older property up here. It's almost 40 years old. In the last month, I literally had $8,000 of unexpected repair. It just, everything that could go out did. That's an extremely unusual month. I haven't had a month like that ever in 10 years with any of my properties. It was just unlucky. But with that being said, if you're looking in San Antonio Metro, you can get a new build property that's right down the street from established neighborhoods. You know, you have everything built out and ready, and the price points are very comparable. Like when you consider your low maintenance, the builder warranties, it's a slam dunk. It definitely makes sense.
Definitely. A lot of these options that we pick, we do shoot to be around good established single family neighborhoods, good established schools. So you don't, if you're still looking for that, because that's maybe what appealed you to more older established neighborhoods with nice aged trees, you can still, and you still can get that in maybe getting a new construction, because still think of it as an area. I think above anything, when you invest with real estate, you really, above anything, invest in the area, because that's what's going to more so matter over time. If there's any area in California, New York that just, you know, either really appeals to you, you've always wanted to be, or you're already at through hard work, you know that it's really, usually the area that sold you. The job core, maybe it's close to your job, it has great opportunities for networking, great schools for your kids. So, you know, don't fixate too much on the other small details. You know, as time goes along, we see a lot of these areas slip and become unbalanced, and then before you know it, it's harder and unobtainable to get your foot in the door. But really always focus on the area as a whole and what it really brings and what the appeal is. So these are some hand-picked options that we're going to go through real quick. This is a San Marcos property that we have, so I'll pull up. This is right kind of San Marcos and Kyle areas. This kind of is closer to Austin. San Marcos is considered Austin metropolitan. So it's only about 25 minutes from South Austin, which is great. We usually do not see new construction in Austin too frequently within a price point that can work for investment. So usually a lot of new construction. Austin is stricter on codes, it's more expensive. They've had such an influx of people moving there, even though it's still less populated than many of our other cities, it's still been pretty high on the growth rate. So it's growing rapidly. And with that, through COVID, a lot of builders pulled back from working with investors. So we've seen a few open back up, but usually the first ones that are eager to open back up are so insanely priced that, you know, yes, you could buy there as an investor, but you'd have to put 60% down before you can make it comfortable for yourself. So it just may not be ideal. This one, however, is pretty affordably priced. It is still on that I-35 stretch that I vouched to you guys about. Interesting enough about, we'll look at the numbers here in a second, but interesting enough about this area is they just got approved a San Marcos studio. So this is actually going to become, this and the one in Bastrop are going to be the largest ones in Texas. Two different owners between both, but there's actually a pretty large film scene coming to the Hill Country. Land in this area is still cheaper than most, and with the Austin kind of arts scene, it's it kind of turning into a little bit of, I guess, what you would expect in an LA, but this is going to actually bring in several thousand jobs for these film studios. So it's very interesting that's coming in. Then we also have a $60 million senior living community coming right in San Marcos. So San Marcos has typically been a college town. It's home to Texas State. That's one of the biggest populations for any university in our state, but it's become more and more diverse with different things like its Job Corps, commercial projects, the over 55 living communities, luxury developments. So it has grown past that, and it's continuing to get more and more of that rep. And it's pretty on par with New Braunfels, but it is a little bit higher price point. So this is the numbers. So you can see right here, this is the monthly income. So these are all the expenses of the home month to month. This is at a 30% down for this property. You're at about 117 for this purchase. This is a pretty spacious home. So it's 4-bed, 2-bath. It is 1,600 square feet. They have all sorts of amenities in this neighborhood as well. Pretty good schools. Maintenance is low. You have a 10-year home warranty. So your break even for the investment. So these month-to-month expenses, including management, are going to pretty much be break even. Then our variable things, the things that vary month to month based on if the tenant stays, how long is the vacancy, is there any maintenance, then you're having that out of pocket for about the first year. So when you see your first rent increase next year, you're going to be bumped up and you'll be good, because the average for this area is going to be about 150 to 200 for the rental increase. And so a small amount of time, this negative 200, you'll be fine. And if the tenant renews for the first year cycle, which the average for an A class is going to be about 3 years, it's about 2.5 that we see for a tenant cycle for an A class home. So more times than not, you're not going to have a vacancy after the first initial tenant. They're usually going to stay for that period of time. So you would not really build in these expenses, but it's still good to put it aside just in case it does happen. So this is for the first year. Again, kind of keep in mind the appreciation factor that I told you later. This is not great numbers for cash flow. It's nothing that you're probably going to instantly retire with. But as we edge to Austin, these numbers moved more over time, not just since COVID, but if we're doing the 30-year measurements between San Antonio and Austin, that's what we see. So again, depends on your goals, your time frames, what you're looking at. This is more of an appreciation play. This is our Jordan Creek duplexes. So we've had these on our websites. It's a community we've been doing for the last 2 years. It will wrap up at the beginning of next year. So the good thing about that is that the community will be finished with these last few duplexes that we'll be selling. These are the best per unit cost you can get for a luxury duplex. So 2-car garage, luxury vinyl plank, 9 feet ceilings, granite countertops. It really has all the bells and whistles, a sprinkler system. When we look at the cost, this is where the property is at in Seguin. So this is a little bit south of New Braunfels. This is at 489. So we're in the 490s for a lot of these duplexes. This is the numbers. So you can see here, you're at 200 for monthly income, and this is at 30% again. And then after your variable expenses, you're about negative 151. Again, because it's a duplex, usually the average is 2 years, so it goes down a little bit, but you can still expect to probably keep the tenant after the first year. So you don't have to immediately save these expenses if you don't want to. These are just what we recommend, but they're not exactly what's going to be true for the investment over time. They're just really a guide for what you should expect based on the class of the property, the appeal, etc. But the per unit cost, so if this is 490, you're looking roughly at about, for these, you're looking about 245 each unit. So if you try to find similar new construction, 2-car garage, good square footage, all of these things in a single family home in Seguin, the average really is about 310. So you're saving on the per unit cost, and the cash flow helps a lot better when you get that 2-in-1. So it's a little bit of the Costco mentality, you're saving a little bit. So if you have the intent of thinking between getting a single family home or getting a duplex, or I'm sorry, 2 single family homes or a duplex, and cash flow is at the top of your mind, something like this is going to save you more money. So it's going to save more of your capital in case maybe you want to make other investments, save for the next home, and you're going to do better on the cash flow. Now, 2 single family homes are going to appreciate more over time, not maybe significantly appreciate more, but they are going to appreciate more. Again, a single family home has a bigger buyer pool now and forever. It's going to be what most people always want. And it's probably going to be a little bit bigger in size. And there may be other appeals to the area depending where it's at. So those are the dynamics between the two. This is the development. So I believe a lot of these will be wrapping up on this last street here. And as you can see, this is the whole community. Good thing about Jordan Creek, it's surrounded by luxury single family homes. So yes, you're around a lot of duplexes here in this specific quarters. But there's three single family home builders that connect to this neighborhood. So by this road and by this road connect to, I believe it's Harkin Heights. I'll send information in the email so you can kind of have the overview of what is the appeal here. But I love multifamily near single family because it really, those values help a lot in the overall appeal of the area. When there's just an oversaturation of multifamily in a renter class of the area, um, renters are never going to care as much about as a home as primary owners are, because primary owners, they own the property, it's theirs, they take pride in it. It's going to be different. I'm not going to, you know, especially when a rent's higher and we do a very good job in vetting a tenant, they're going to take good care of the property, but they're just never going to take as good of a care of a property as a primary owner. So when you throw in several developments that are mostly primary buyers and owners, it's better for the whole area in totality and the appreciation overall.
In this particular builder, for any investors that aren't familiar with it, does everything and to be like very, very, very durable. So stained concrete flooring, stainless steel, granite countertops. It's meant to keep your maintenance very low.
These ones are luxury vinyl plank, so it's not stained concrete, but again, like Rachel said, they're building to all the most recent coating. They've been around for a long time. So these builders have been building duplex inventory for us since 10 years ago. So they have a good reputable thing going. They have a full staff. We've worked with them. We manage their duplexes. We couldn't manage a builder who constantly makes terrible product because it'd make everybody's life living hell. But you know, the proof is in the pudding. So this is a little bit of the proximity figures for Seguin to these other areas that you can see here in the map. This is a few stats on Seguin. So if we look at an even micro level of our area in particular, Seguin is even a better cost of living index that in San Antonio compared to these other areas. Seguin has a huge blue collar workforce, and so that makes it very desirable for tenants. A lot of them aren't ready to buy at the moment. So we get renters there very quick. And as New Braunfels has edged up and the inventory has gotten really scarce there, a lot of people move south to Seguin. So we've seen a lot of these duplexes lease very, very, very quick because of that. So this is our last one. This is going to be our country club duplex. This is really going to be the best one for cash flow numbers. The compromise is no parking, no parking garage, I guess you should say. So you have a same square footage on each side. It has a lot of great features. Still has the stainless steel appliances. This one does have the stained concrete flooring. It does have the bigger backyards and patio on each side. And overall, it has a very clean, modern look to it. It's probably one of my favorite styles for any of the multifamily we have, but you do not have the garage. That saves, of course, on the cost of the overall building. And the good thing is the rents are very balanced. This is going to give you a maximum amount of cash flow on these ones. We have some that are coming up to close next month. So we have one left for this community. And these ones are at, so these are also in Seguin, as you can see here. These ones are at 445. So these are almost about 220 a unit. So to find new construction units that are 3-bed, 2-bath, each side 220 a unit, it's very rare for our parts of Texas at least. These are the overall cash flow numbers. So you're making about 250 a month on the property on the fixed expenses, and when you do the variable expenses, you're about -80. So that was the best of any of the ones that we've seen so far. If you even edged the down payment to about 33, you'd be break even for the whole investment, even after your variable expenses. So that means truly the investment would be passive. It would be paying for itself as long as you save the estimated amounts monthly. You'll be in a good position with this home. None of the other ones really do that. Now, again, there's the trade-off of overall, I think the luxury one will appreciate a little bit better because of its size and its options, but it depends on your goals. Again, maybe cash flow is at the bulk of what you're trying to do with your income is replace your income in a shorter amount of time, this would be the one to do it for. Where if you're really trying and have the time for wealth building, the San Marcos one would be the top one for you. So just kind of to give you some variance of the different types here, that's the duality that we're looking at. So I'll be going ahead and sending you guys all the properties that we went over. These are all available at the moment. So, if you have any questions, do let Rachel or me know. I'll give you my information. We look forward to hearing you guys, and thank you so much for listening to us this evening, and I hope to hear from some of you guys soon, but I'll pass it off to Rachel for now.
Thank you, Ken. And yes, we'll respond to any of the questions that came in this evening tomorrow. So thank you guys for coming out tonight. Just real quick, for anyone that isn't currently working with an advisor, like I mentioned at the beginning of the call, I am a licensed agent in both California and Texas, but I do serve in the capacity of a liaison to our partners across the country in all of our primary markets. So think of me, I always say, if you like football, think of me like a quarterback. And if you don't, think of me like a concierge. So I'm able to connect you with all the partners in our different markets. So we'll connect, set your goals out, evaluate the different options, decide the time frame that works best for you. Take a look at the different criteria that you would like to pursue. Identify the markets. Obviously, you on the call tonight are probably interested in Central Texas. I'm a huge believer. That's where my biggest assets are. So I definitely believe in this market, and we'll introduce you to all the key players. Read Kian. Oh, hold on. And one more time, I'll put my info up on the screen for you guys. You can capture it if you don't have it handy, but thank you guys so much for your time this evening. We loved talking about these options. It's been a little while since we had any inventory to discuss. So we appreciate your time, Kian. Thank you for all the great info, and hope everybody has a wonderful evening. Talk to you later.
Thank you, Rachel. Take care, everyone.